Welcome to my channel. My name is Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Blueknight stock and analyzing its financial ratios. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me to discuss financials, receive a custom valuation for a stock of your choice, or just support the channel, you can become a member by clicking on the link in the description below. Blueknight is an oil and gas midstream company. Midstream refers to the points in oil production process that falls between upstream and downstream. Midstream activities include the storage, processing, and transportation of petroleum. We're going to look at the ticker BKEP. This is Blueknight's common stock, but they also have another ticker, BKEPP. That's their preferred stock. Preferred stock is higher in the capital structure. So in the event of default, bondholders get paid, then preferred stock, then common stock is last. Preferred stock is like a hybrid of debt and equity. Preferred stockholders receive a guaranteed dividend payment, but preferred stockholders usually do not receive the benefit of appreciation of stock. If a company is doing really well financially, common stockholders may see their stock price double, triple, even go up 10 times, where preferred stock usually doesn't go up much. Let's get started with the model. This is a small company, 63 million market cap. That's the value of the company according to the stock market. And they're trading at $1.53 a share. And they have 41 million shares outstanding. To calculate shares outstanding, it's market cap divided by stock price gives you shares outstanding. Let's look at the financials. Free cash flow, that's how you value a company. You estimate the future free cash flows and then discount that number back to today's value. That's what I'm doing in this video with you today. And free cash flow is cash flow from operations minus capital expenditures. Capital expenditures are property, plant, and equipment. If a company has positive free cash flow, it has the ability to pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things. And this company has positive, pretty consistent free cash flow each year, so it looks like they have cash to work with. But their net income is negative in a couple of years. Net income is the profit and loss on the income statement. It's revenue minus expenses. So it's the bottom line of the income statement. And 2 of the 4 years, they have negative net income. Let's look at the income statement. So when you look at the income statement, on the very top is revenue. You should look at operating income. You should make sure that's positive, because if that's negative, that's a real bad sign, because you want the company to at least operate profitably from their everyday business. If they're not, they may go out of business. Below operating income is the interest they pay on their debt, and you want to make sure that's less than operating income, and it is. Below the interest payment is other, and the other items are usually not predictable. They can come at any time, and they could be really big or really small. Impairment of assets is bringing down their net income, especially in 2018. It brought it down $53 million. Now, companies need to look at their balance sheet periodically to make sure the assets aren't overstated. A common asset that becomes impaired is accounts receivable, goodwill, and long-term fixed assets. To give you an example, if this company has a piece of machinery that on its balance sheet is worth $10 million, but the market says the machine is only worth $8 million, the company has to reduce the machine on its balance sheet from $10 million to $8 million, then take the $2 million and pass it through as an expense onto their income statement, and they put it here, an impairment of assets. So it does bring down their net income. It doesn't affect cash flow because they purchased that machine years ago. If you look at the statement of cash flows in the cash flow from operations section, it starts with net income of negative 42 million, but then it adds back the 53 million from the asset impairment. So their free cash flow is actually positive for the year, even though they had negative net income. That's why you should always look at cash flow in addition to net income. Their revenue looks pretty good. It doubles from 2016 to 2019. So they're moving in the right direction. It did dip a little from 2018 to 2019. And they have $256 million of debt, and they have negative equity. When a company has negative equity, that means the liabilities are greater than the assets on the balance sheet. They pay 5.83% interest on their debt. This company is structured as a master limited partnership, and MLPs do not pay taxes. To qualify, the business must receive at least 90% of its revenue from natural resources or real estate. This company receives all of its revenue from natural resources. So they're 100% debt because they have negative equity. Their beta is 2.14, so the stock is pretty volatile. It moves more than 2 times the market. Their WACC is 5.83%, which is the cost of debt. The WACC is a discount rate companies use when they want to take on new projects or acquire another business. If a new project came along and this company had to pay $1 million to take on the new project, but they would receive $100,000 of cash flows each year for the next 20 years, what they would do is they would discount those 20 years of future cash flows back to today using the weighted average cost of capital. And if the value of those 20 years of cash flows equaled $1.5 million, they would take on the project because it cost them $1 million and they would be making $500,000, so the project would be profitable. But if they discounted those 20 years of cash flows and in today's dollars it equaled $800,000, they would not take on the project because it cost them $1 million and they'd be losing $200,000. You only want to take on projects and ventures that add value to the company. And the WACC of 5.83% is a discount rate we're going to apply to the future cash flows for this model. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $36 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $106 million. We divide that by 41 million shares. And we get a calculated stock price of $2.57. They're trading at $153, so they're trading at a 40% discount. It's a buy according to the model. Simply Wall Street is even higher than me. They're at $305 a share, so they're saying it's even more undervalued. Simply Wall Street uses the average analyst estimate to come up with their valuation. Let's see where the stock has been trading the past few years. The stock peaked at about $7 3 years ago, but it's been coming down ever since. It looks like it's at a really low point. It seems really undervalued according to my model and according to Simply Wall Street. Their dividend has been dropping also the past 5 years. It used to be 14 cents, now it's down to 4 cents. Part of the decrease in dividend has to do with the lower stock price, but I believe a big part of it is due to cost cutting. It's good to understand that the stock price is not directly related to how well a company is doing financially. It's a function of how the stock price does, but what's directly related to the stock price is supply and demand of the market. The more people that buy a stock, it pushes the price higher. The more people that sell a stock, it pushes the price lower until equilibrium is met. But investors keep buying the stock because they think the future of the company is going to be great. Sometimes a company is doing well financially, but people keep selling the stock or nobody buys the stock because investors feel the company is going to be struggling in the future. The stock market's forward thinking, so you have to try to understand the psychology and market sentiment, which is a really difficult thing to do. Let's look at the financial ratios. Great PE, the median is 16.4, the average for the market's 18.3. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. I like to see below 15, they're at 3.4, so investors are paying $3.40 for $1 of earnings. That's an amazing ratio. Price to sales is also really good. The median in the market's 2.0, the average is 4.8. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5, they're at 0.2. So investors are paying 20 cents for $1 of revenue, also another amazing ratio. Price to book is bad. The median is 2.4, the average is 5.0. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. We can't look at their price to book because it's negative. They have negative equity. Equity is total assets minus total liabilities in the balance sheet. A good interest coverage ratio, the median is 4.1, the average is 14.7. Interest coverage ratio is EBIT over interest expense. I like to see above 2.0, they're at 2.4, so they can cover their interest payments. EBIT is earnings before interest and taxes. It's called operating income on the income statement. They don't have a good ROE. The median is 12%, the average is 13%. ROE is net income over equity. They're negative, so we can't look at their ROE. They have a bad current ratio. Median is 1.3, average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 0.6, so they cannot cover their current debts and payables, which means they may need to take on more debt. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables that are due within 12 months. Examples are current debt and accounts payable. I've done videos on lots of other oil and gas midstream companies: Intero, DCP, DHT, Enbridge, Enterprise, Energy Transfer, Euronav, Frontier, Green Plains, Interpipeline, Kinder Morgan, MPLX, Noble Midstream, ONEOK, Plains, PBF, Pembina, TK, another TK, the Williams Company, all in the same industry as Blueknight. And if Blueknight has a number in red, they're worse than the average. If they have a number in green, they're better than the average. They're doing a lot better in PE ratio of 3.4. The average is 8.5. Price to sales are also doing a lot better, so that's good to see. Sales and earnings are very important when looking at a company, but they are doing bad in price to book because they have negative equity. Current ratio, they're doing bad, but most companies in this industry are struggling. With coronavirus, that's expected. Next year, these ratios should improve. ROE, they're negative, so we can't look at the ROE. They're 100% debt, so they're doing poorly there. Of the 21 companies, they have the smallest market cap. They have 11.27% dividend yield, which is really high, but it's smaller than the average. This industry pays a massive dividend. DHT pays a 36% dividend. To summarize, I do have them trading at a 40% discount because their stock prices come down so much, but their ratios look pretty weak and their financials are decent. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me to discuss financials, receive a custom valuation for a stock of your choice, or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.